Investment Summit. It's nice to see a few familiar faces and some new ones as well. I'll start with a brief introduction to our panelists, but then we'll move to a few slides to contextualize what we'll be talking about and also present the work of ARIA, which is one of the initiatives we'll be speaking about. And then we'll move on to the panel and then leave some time for questions and answers at the end. So this panel is sponsored by British International Investment, where I work together with Fadi. I'm a manager in the technical assistance team, leading our portfolio focus on financial institutions and also focus on initiatives in frontier markets, such as ARIA. So I'm delighted to be here with Fadi Bassir, an investment manager in the private equity funds team at BAI, Imran Patel from Verdant Capital, director focused on Francophone West Africa, based in DRC, Nicole, Poindexter, CEO and founder of Energicity Corporation, which has access to energy projects in Sierra Leone, Liberia, and Benin, and Dia Martin, a managing director at DFC, the US Development Finance Institution, leading a very innovative portfolio of investments, high impact and high innovation. P4 squared, right? So maybe just to kick us off, I'll present a little bit about what we'll be speaking about. So if we could move to the other side. So this is probably not very new to anyone, but access to capital, access to finance is a big need for businesses in frontier markets. When we look at countries like Sierra Leone, DRC, Ethiopia, the level of development of the financial sector is very low compared to regional peers, which results in low levels of access to credit for businesses, and they report that as a big struggle. And you can also see some of the collateral requirements. So in general, businesses in those markets are starved of capital, preventing their growth. There's a huge impact opportunity in terms of access to capital, both in terms of job creation, developing sectors, developing industries, supporting with political stability, and also in terms of reducing inequalities between countries. When there's more investment, those inequalities can reduce. Investment also can lead to development of business ecosystems. The enabling environment can improve as policymakers support investments. And also ESG, especially from international investors, ESG practices can improve within businesses when investment comes in. And often when we speak about markets like Sierra Leone, Liberia, DRC, where the ARIA initiative is focused, people instinctively say, oh, there's no investment opportunities in these markets, which couldn't be further from the case. In particular in sectors such as agriculture, infrastructure, where there's big needs. For example, access to electricity is so low in Sierra Leone, around 10%. That's a huge opportunity to support meeting those needs through establishing business opportunities. Financial sector is another one where we see quite a lot of investment opportunities. Manufacturing, and especially supporting import substitution, as a lot of products are imported into these markets. Logistics, equipment leasing, hospitality, health, education. There's a lot of opportunities where the needs are unmet. It's fair to say that although there are opportunities, there are challenges, because otherwise everyone would be investing there more than they are now. There are macro-level challenges around the enabling environment, around policy. There are also sector-level challenges around the risk-return profile and the appropriate capital that should be there to meet it. There's also challenges around the specific transactions, and we've broken those down as transaction costs and information asymmetries. And the ARIA initiative, which I'll speak to about, is designed to support some of those challenges so that investors can invest more in these markets. So ARIA is an initiative bringing together development finance institutions, impact investors to invest more in frontier markets in Africa. It's funded by BAI and FMO, so the UK and the Dutch development finance institutions. But we bring together a number of DFIs, FinFund, Norfund, DFC, a number, I think almost all the DFIs are members of ARIA, all or the bilateral and multilateral DFIs. Our first countries of focus to start with are DRC, Ethiopia, Sudan, Liberia, and Benin. Thank you. And we've got partnerships established with donors on the ground, including FCDO in Sierra Leone, FCDO in Ethiopia, USAID in DRC, to support facilitating investment. Our results to date show that there are opportunities in these markets. We're working through a database of about 300 businesses. We've screened around 100 of them. Around 45 have been passed on to relevant investors, and a number of them are in the pipeline already for investors. So there are opportunities in the sectors that I mentioned. We offer a range of services, both for companies where we support their investment readiness. We provide technical assistance, advisory, for example, looking at the financial models, business plans, etc. We support connecting with relevant investors, because it can be quite overwhelming for a business in Sierra Leone to understand who and which development finance institution or impact investor to reach out to. So we're trying to connect the dots between opportunities and investors. We're also, for DFIs, helping the due diligence process, helping deal sourcing. We have this database that I mentioned. We pass on deals, so especially it's relevant for investors that don't have a presence on the ground, which is really the case in a lot of these frontier markets. And we're helping to solve for that through having a team in each of the markets. And we're also working very closely with development partners, bringing synergies to their private sector development programs. So maybe just to leave us off before I move on to the panel, a couple of examples of real opportunities. In one of the markets that we're working in, we're working with an agro-processor that's a national champion, one of the biggest producers of vegetable oil, soap in the country. Their revenues are over $250 million, their EBITDA is $36 million, and they're struggling to get a working capital facility for $1 million. So this is the real challenges that these markets face, and the banks can't provide the capital for structural reasons. They struggle to access dollars, and then international investors are not so comfortable with the country, and that's really the gap we're trying to bridge, and this investment's already being pursued by one of our DFI members. Another example, a telecoms company in one of our markets is looking to solarize the towers, looking to extend the fiber optic cables to provide access to internet across the country, and they're looking for a $20 million debt facility. And they're, again, struggling because investors are not comfortable with the market, even though this is a very attractive commercial opportunity. But I'll leave us there. If anyone is interested in any of the markets that I mentioned, here are the people to reach out to. They're on the ground, happy to help facilitate investments. But now to move us on to the panel, maybe we could remove this presentation, if that's okay, and move to the discussion. So I'll start, if you wouldn't mind, Dia, to kick us off in terms of speaking a bit more about your role and about how you're working in frontier markets. I know we work quite closely together under the ARIA initiative, but it would be great to speak about the DFC work.
Sure, I'd be happy to. So it's a pleasure to be here this morning. I work for the U.S. International DFC. Hello, I work for the U.S. International DFC. We're the U.S. government's development finance institution. We have a portfolio of approximately $40 billion. I'd say a quarter of that portfolio is focused in sub-Saharan Africa, and we're always looking to invest and do more. Specifically at the DFC, I lead our portfolio for impact and innovation. This is a program that is focused on early stage, highly impactful social enterprises and funds. We provide financing of up to $10 million through this program, and this is specifically to help companies and funds at this level to scale. We work with first-time fund managers, innovative funds that are focused on impact and have maybe a slightly unique capital structure. And we work with companies in multiple sectors, from financial intermediaries to hospitals. I'd say for us, this has been really important in the ARIA initiative as well. As I mentioned, we have about 11 billion or about 12.5 billion portfolio in sub-Saharan Africa. but we see that our portfolio is underweighted in the countries that Alex mentioned and the countries that Aria is targeting. And so we want to do more, and I think an area that we can do more is through this Portfolio for Impact and Innovation program. We have done work in these markets, and I think for us, it seems like a lot of our success has been with financial intermediaries. So we've worked with some financial institutions, banks and NBFIs to provide financing to support SMEs. But we also think by directly investing in SMEs and funds that we can continue to grow our portfolio and serve these markets. So I'll pause there.
Great, thanks, Nicole.
Hi, everyone. My name is Nicole Poindexter. I am the CEO of Energicity Corp. We are a solar mini-grid utility. We are operating in 3 of Alex's markets, Sierra Leone, Liberia, and Benin, as he mentioned. And what we do is we provide light. We provide light in rural communities that don't have access to it through other means. And you know, to your question about commercial opportunities to invest, I think that there are many. We as a company, but many others, are really serving real needs in Africa. I talk to a lot of, and I'm sure all of you follow kind of the venture markets in the US, and I make snide comments just a few times. And, you know, and one of them is like, we're providing electricity. There are other companies that are providing, for instance, Max in Nigeria is providing mobility, but also a financing platform that makes mobility accessible to Okada riders or motorcycle riders or electric motorcycle riders. We've got companies that are providing vital, like Sanergy and Sanergy subsidiaries, vital fertilizer and composting services. The companies in Africa, for the most part, are serving real needs. The snide comment is, you know, the latest venture to be funded in the US is probably finding you a new way to buy pet food. Not a real need. We are serving real fundamental needs that customers will pay for. They're usually already paying for them, and we're providing easier, lower cost ways for people to meet those real needs. And so I would say one of the fundamental things about commercial opportunities in Africa is that they are real. That companies are meeting these real needs, they're meeting them in innovative ways, and if you want to invest in a real business, this is exactly what you want to invest in. That doesn't mean that there aren't challenges, and I think we'll talk more about them, but that's, I think, the most important thing to know about the commercial opportunity here. We call it impact, but that's just because it's real.
Imran, do you mind talking a little bit about Verdant Capital and your work?
Sure. So Imran Patel, I'm a director at Verdant Capital. We're an advisor to companies such as Nicole's, who are delivering impact of all kinds across sectors, real needs. I think she summed it up very well. And what we really do is in advising companies, entrepreneurs, shareholders, as well as potential investors, we help bridge the gap of in misperceptions of risk, misunderstanding, or perhaps not appreciating the potential investment opportunities, and balance those against the mandates that investors may have, and the structures and types of investments they would, you know, the structures, how they would structure the investments into these companies, and tailor it effectively to the opportunity, and also match across the board. And we work across Africa. I lead the Francophone side of the business, but my colleagues work in East Africa, Southern Africa, and we're growing. The reason we're growing is that there's just that much more interest than there was when I joined the firm 7 years ago. I believe more and more investors are beginning to appreciate the opportunities, but equally there are those that are finding it difficult to convince their committees or their boards to disperse those funds for one or more reasons. And each country is very different. The challenges and opportunities are unique. So we provide that local expertise and knowledge across our 6 offices, and we're continuing to open more and more offices over the coming years.
Thanks, Fadi.
Hi everyone, good morning. Very, very nice to be here this morning. So I work for British International Investment, the UK's development finance institution, around 75 years old, investing across Africa, Asia, and the Caribbean more recently. We have a balance sheet of about $10 billion, and we've been investing in some of the markets that we're here to discuss for many, many decades. My role specifically is sitting within the private equity funds team, so allocating to fund managers and funds across our markets in the sort of 2-3 continents, but that includes investing with fund managers who are going into some of these frontier markets and who are allocating either equity, debt, or in my case, through the funds business into companies across these regions.
Great, thanks. And Nicole, you touched upon this in terms of the commercial case for investors to look at these markets, but that's something I really wanted to dig a bit more, because a lot of the time when we talk about frontier markets, the risks, people worry that there's no money to be made. So what's your impression? Is there a commercial case to look at frontier markets?
Can you hear me? Absolutely, there's a commercial case. Again, as I said just before, in many cases, businesses, and particularly businesses that thrive in Africa, are providing solutions to needs that customers already have, they already know they have, and they're already spending money on. And to give the specific case for energy access, our customers, and in fact, it was FCDO, did a study of the cost of acquiring a kilowatt hour in Sierra Leone before our mini grids came in. And they found that rural customers were spending the equivalent of $12 a kilowatt hour on batteries, on getting their phone charged, on diesel gen sets, but $12 a kilowatt hour. Now, as a solar mini grid provider, providing access to energy, we're building the whole grid, we're putting in batteries for 24-hour power, we're putting in all that infrastructure. And yes, our costs are higher than Europe, but they're 50 cents a kilowatt hour. So rural people who are making $1 a day are saving $11.50 a kilowatt hour by going to a new service. Is there a commercial opportunity there? I ask. There's a huge commercial opportunity, and there are 600 million people who need electricity, so there's a huge market. And again, there's some complications, but there are many businesses who are filling these gaps where people are paying exorbitant prices to achieve basic needs. And once those needs are met, the opportunity doesn't stop there. Because they've been deprived of these basic needs, there then is new opportunity for growth. One of the things that we did as part of our business is, on top of providing electricity, we realized people needed access to finance, they needed wiring, they needed freezers in order to really benefit. So now we provide a huge number of value-added services on top of the electricity platform. And you find that many companies are innovating, delivering that basic service, figuring out that in order to meet that basic need, there are new opportunities, and either they're filling them or new companies will. But there's a huge commercial opportunity, and it is commercial. I had the fortune to be on a panel with Michelle from Kawasaki, who's sitting right there, and one of the things that she said as she talked about how she evaluates businesses, is she looks for entrepreneurs who are very practical, who have a practical assessment of the market. I shouldn't be quoting her. You can get the direct quote from her directly. But they're very practical about how they access the market, and practical about their growth perspectives. And I think that not just are there companies that can meet a real market need, but there are entrepreneurs who really know how to do it. So with that,
Great, thank you. I'm trying to get another mic to avoid the walking around. Dia, you're making a lot of investments in very innovative early-stage ventures, including in some of the frontier markets that we work on together. How do you see the commercial case? Do you see the performance of your portfolio doing quite well?
So yes, we have had examples of investments that have done quite well. As I mentioned, we've done a lot of work with financial intermediaries One I would mention is the International Bank of Liberia. We provided two loans to them of about 20 million. The first one was successfully repaid. We now have another loan that's outstanding with them. And we've seen the same with other financial institutions we've worked with in these markets. I think when you talk about commercial opportunities, yes, the commercial opportunity is there. I'd say as an investor, one of the things that we've seen is a wide range of opportunities. We've been able to come in. A lot of these opportunities are untapped, so we're able to have access to opportunities that we wouldn't have access to in other markets as a DFI. I also think, and Nicole, you talked a bit about this, the pragmatic nature of the entrepreneurs, because they don't have a plethora of capital that's being thrown at them. They're very practical in how they use capital and how they grow their business as well. So these are really entrepreneurs that are focused on cash flow. And when you're looking at lending, this is really important for us as we look at being able to get our principal, get our investment back. Also, I think what's really important as you look at, and Nicole, you mentioned this, the different sectors that we're able to work in. We're looking for high impact, and a lot of these, just by the way they've structured their business to reach their markets, to reach individuals that are underserved or in rural areas, the intrinsic nature of their business is high impact, the ability to be able to provide cost savings to their clients as well as employment, that a lot of these investments hit our impact targets as well as our commercial targets. So we're really excited about the commercial opportunities in these markets, and we hope to do more and invest more.
Thanks. Imran, you work for a transaction advisory company, so it's your day-to-day to match investors with opportunities. So from your perspective, do you see opportunities being there in DRC, for example?
Yeah, we see there are a lot of opportunities, and across the sectors you showed on a slide earlier. Some of the biggest opportunities are actually in food production. You know, most of the food in the DRC is imported, and it's not that there is a lack of fertile land or capable entrepreneurs and businesses operating businesses that are already addressing this import substitution. It's it's the access to the capital, the banks that that lead financing in the market, in this market, have very onerous conditions, including the guarantees. Guarantees can go up to 200% over there, and we're looking at transactions or loan requirements of anywhere from 3 million to 50 million. And when you reach the higher ticket sizes, yeah, they may not ask for 200%, but when you ask for even 100% guarantee, it becomes very difficult to access that funding. So we need to help these entrepreneurs and businesses access international capital markets where the funds are obviously institutional and have a governance process, ESG requirements, and everything else that they look at in terms of assessing an opportunity and then structuring and dispersing a loan. So we step in and help put the whole dossier together, the data room, help the companies manage the process because they have a growing business, if not a sizable business, to run while this process is ongoing, and these processes can take up to a year. So it's a significant time commitment. And there's a lot of data points, and being present on the ground, we really bring forth, we're able to address a lot of the concerns that investors may have so that they can ultimately fund such opportunities, earn a return. As Nicole mentioned, these are commercial opportunities, but the investors also, depending on the type and nature of the investor, private funds seek more commercial type returns, DFIs have more concessional returns or in terms of blending the structure and so forth. But in the end, it has to meet a return hurdle that the investor has, and that hurdle is driven by risk perception and all-encompassing risk, not just operating or financial, but also you take the politics. Lately, there are a lot of headlines that are hitting the media about what's happening across Africa, but these are also political headlines. In the end, people still need to live, people still need electricity, people still need food, people still need mobility services to move around, roads need to be built, and we have to keep providing these solutions, delivering the capital to the opportunities that deserve it, and keep the economies growing. And in any sector, there's such a huge gap in terms of the global averages and what the country-specific average is for any given sector, that the opportunities are almost endless. And I think we can have 10, 15, 20 years of just capital coming in. And a lot of these, especially the ARIA countries, they have not been beneficiaries of these large capital inflows since the early 2000s. And that's also an opportunity for us as advisors, for investors, but also as entrepreneurs and businesses looking to grow. You can grow well beyond the accessing traditional banks. The DFC and other DFIs have been supporting banks, but then the banks are also, they evolve their processes at a pace that's not always aligned with the entrepreneurs and companies' businesses' demands. And that's, again, where we step in to fill the gap. For example, 5 years ago, we raised $7 million for an integrated agribusiness. The company has scaled 5 times since then, or 4 times, and now we're raising $20 million to help them continue their expansion. That loan that we raised 5 years ago is going to be fully paid out, so the balance sheet is going to be debt-free by the end of this year. So we're looking to onboard that new loan in Q1 of next year. And this is only going to take their land a cultivated area to 4,000 hectares. And they have 20,000 more hectares to develop. And we need, let's just say, 50 more of these operations to even put a dent into the import of a staple product such as maize meal and maize flour. So again, that's just one sector and one company. But we need, so much more in agriculture. And then we can go on and on about electricity. Congo is blessed with, more than 50% of Africa's fresh water, yet it has about 11%, access to electricity. So everything from solar to hydro, these are all opportunities that exist, greenfield, brownfield projects. Then you have not just a generation, very often in the power sector, people forget about transmission and distribution, mini grids, the prepaid aspect, the last mile. The list just goes on and on, Alex.
Thank you. I think something you touched on, Imran, which I'm keen to ask Fadi about, is this perception versus reality gap. And quite a lot has been written quite recently about a number of African markets actually paying a premium for capital because of that perception versus reality, perceived risk versus real risks. So I'm keen to understand, how do you see that? We as BAI have invested in these markets for a long time, so we do have quite a lot of experience, but where do you see the gap between perceived investment opportunities, perceived risks, and the real? What's happening on the ground?
Yeah, sure. So I think from our perspective, in order to really tackle this gap, I think it really comes to partnerships, right? So I think, as I mentioned earlier, I work with fund managers, some of which are in this room. And we see those fund managers as our, on-the-ground partners, eyes, ears. These are guys who live in these markets, grew up in these markets, went to university in these markets, and have been around for a long time. So we focus on partnering with individuals like that who understand the market, understand, these are the companies that you should work with, these are the companies that perhaps you shouldn't work with, but also understand how to navigate those particular markets. So, I'll give you an example. Probably about 4 or 5 years ago, we were investing in one of the frontier markets in West Africa. And what was great about this particular instance is that we were working with a group of individuals who had sort of mapped the market and identified sort of various areas whereby as a traditional investor, you want to go into an established business, you want to go into a business that's running, but they were able to start their own businesses. They were able to say, well, look, this is a market where M&A activity isn't as rampant, so let's, not to say you can't find deals that way, but maybe let's take a different approach, and let's look to grow businesses. And so over a period of about 4 or 5 years, they were able to grow 3 or 4 successful businesses in various industries, from education to logistics. And for us, that was an intelligent way to tackle that particular market. We've done it in that way in terms of building businesses. We've also done it through acquisition of businesses. But you have to really look at the market, understand, this is how things operate, and sort of tackle it in that way. So I think for us, it's about partners. It's about partners on the ground, and that's how we help to close that gap.
Thanks. And Dia, from your perspective, in terms of that perception versus reality gap around investment opportunities?
Yeah, I think a lot of it has already been said. I totally agree. For us on the lending side, it's about working with equity partners on the ground, investors, working through intermediaries to kind of build companies up to our pipeline. I also think a part of it is about exposure as well. And I think that's something that still needs to be tackled, at least for us from a DFI side. We recently, when we transitioned from OPIC to DFC, one of the things that we did is we actually started to place professionals on the ground as investment advisors and business development officers. And I think that really helped increase the quality of the investments that we see, because we have individuals that are there every day looking at investments for us and bringing investments to us. And I think it's that continued exposure to different opportunities that's allowing us to make more investments in these markets, both direct and through intermediaries and fund managers.
Great, thanks. Nicole, you're an entrepreneur. What do you think investors should do in these markets to better meet your needs as an entrepreneur in terms of products, in terms of approach? How do we need to tailor our approach?
It's like Santa Claus asked me, what do I want? But I would say a couple of things. One, we find, and our business is asset heavy. We build solar assets and grids, and we find actually an abundance of project debt, particularly. There are a lot of interested investors who are interested in putting debt into assets on the ground in Africa. Largely DFIs, and we are grateful for that. However, that is a fraction of the need. Where we see real gaps are project equity, hard to come by, and even though there's this huge market opportunity in energy access, one of the big challenges is we are, from a justice standpoint, saddling some of the world's poorest people with the costs of climate change and the energy transition. And so I personally think it ideally is low-cost project equity, but whatever the cost is, project equity is a real gap. But the biggest gap is corporate equity. It's the venture risk-seeking equity that enables us to build the intellectual capital, the innovation engine, the teams that are able to grow businesses in Africa. One of the things I often say about energy access is there are 600 million people without energy. If 10 companies solve this problem, we are the 10 largest or 10 of the largest utilities in the world. So these are companies that are currently startups, and we've got to grow to be massive organizations, and that takes corporate equity. And really the number of investors who are open to taking Africa risk and know how to grow companies and know how to put equity to work, it's a very small number, and I think that's really the biggest gap, and quite frankly, a huge opportunity for those of you who are in that game.
Great, thank you. Imran, does that resonate with your experience as a transaction advisor?
It does, very much so. There's a lot of debt capital available. The risk capital is where there is a gap, and I think that gap will remain for a while longer to be bridged. Fadi and his team at BII, they support a lot of these equity funds that look to address these gaps, but each fund has a different mandate and criteria, and often it's the smaller companies that are really making a difference that need ticket sizes less than 10 or 20 million, that larger funds who are the ones that make the headlines and we see are more active, their criteria doesn't allow companies like Nicole's to access that capital. And again, as advisors, We specialize in the mid-market, which would include such companies, and we've been able to channel specifically corporate equity into mobility businesses or other renewable businesses, even telecommunications companies. Like we've helped it's now a Pan-African telecommunications company, but when we started working with them about 5-6 years ago, we were raising them 10 million, that was a big deal. Today, we just closed, last year we closed 30 million, and we're on track to do a much larger round sometime in the near future. And that catalytic risk capital helped us close, and the company closed rather, about 200 million in debt from the larger debt providers. But that equity capital helped them enter new markets, innovate and develop new businesses that are integrated with their core business, and just continue to provide more and better services that suit new needs or even existing needs that are not satiated yet. So yeah, and corporates are starting to look more at Africa, but they also have to address concerns from their boards that may or may not have experience, so they take longer. So these deals may happen, but instead of 1 year, it may even take 2 years, right, to close. But it doesn't mean that entrepreneurs should feel frustrated and just abandon hope. You gotta be persistent and diligent and keep pushing, and it'll happen.
Thank you. Fadi, working for DFI, we have a whole suite of tools at our disposal: commercial, advisory, non-commercial. What do you see the tools that are most needed in frontier markets to be?
Sure, no, good question. So I think firstly, and this is based on some of the experiments we've done. I think long-term patient capital is probably, I think for me, one of the key. As I said, previously, in some of these markets, the M&A activity is not there. There aren't as many entrants into these regions as you see in maybe more developed countries in Africa, for example. And so, we've experimented with things like permanent capital vehicles, right? Where we're allowing entrepreneurs, and we're allowing some of our fund managers to take longer to build some of these businesses. And I know people would then ask about exits. Where did the exits come from? And the way we see it there, it's really about how do you build businesses to such a place where they can start to give you liquidity, and that might take longer than the typical 5 to 7 year investment period. So I think having as a DFI and given the way we are funded, we're able to take some of that longer term sort of patient capital route. That's one. I think two, another lesson that we've learned is in some of these markets, you have to be, at least from my experience, you have to be a little bit more robust when it comes to managing costs. I think someone earlier said, when you invest in some of these businesses, these are real businesses with real needs. They don't have time to fluff around with, extravagant, sort of costs, etc. But I think as investors, we've needed to focus on that. Capital in some of these markets is few and far in between. And I think I'll come to something that you were talking about earlier. Being able to make sure that these companies are structured, they have the right governance. Someone is thinking about costs. I think is key. And then the other thing, linked to that point is really around the collaboration that you were speaking about earlier. I think where we've been the most successful in frontier markets is when we've partnered with other investors who bring different things to the table, different understanding of the market. And so being able to work together with other investors who have similar mandates or similar interests, and then bringing all of our tools to play. So as you said, we've got from technical assistance, we've got, sort of internal debt facilities that can do some of the things you were talking about, like solarizing businesses. And so all of us, being able to bring sort of different aspects of what our resources, so what our companies have at their disposal, I think is also really important.
Great, thank you. And I think it's fair to say there are risks, right? We can't sugarcoat that. But Dia, I was wondering how, from your perspective, how do you navigate the risks? So, we had the slide up with a number of the risks, but from DFC perspective, how do you navigate and manage those risks?
I think for us, there's a couple of things. One, just being very clear about what those risks are and what we are signing up for as an investor. And I think with that clarity, one, we could talk about what are some of the mitigation strategies if it comes to currency devaluation or depreciation? How can we structure our investment so that the entrepreneur is not unduly penalized in that situation? If it's about governance or management or team building, is there technical assistance that we can provide? I think a comment came up about exits. One of the things that we're exploring, are there certain revenue share agreements or self-liquidating investments that we can look at so that we can still invest, understand and absorb some of the risk, but be able to kind of structure our return or our ability to come out of that investment. And then 3, I think what's really important is changing the way we look at our investments as a DFI. One, looking at it as a collaborator, I totally agree, but also looking at it from a long-term perspective. So it's not just about the conversation or the one investment, but it's about the journey and kind of working with our clients in more of a partnership fashion versus just, I'm an investor coming in and I expect this return at this point. How can we work together to build the company and build that relationship?
Thanks. And Nicole, you as an operator of businesses in these markets, how do you navigate the risks?
From an investor perspective, a lot of the risks are, from our perspective as an investee, a lot of the risks are kind of managing risk every day is my day-to-day job. Like, my day-to-day job is to manage risks ranging from the incredibly small to the incredibly large. What we find there are a couple of risks that are very difficult for us to manage, and I think that they sit in the realm that Dia is talking about. Currency risk is, I think, one of our biggest. We are operating in Sierra Leone, where the currency over the course of the past year devalued by 100%, unexpectedly. And but that said, there are tools for hedging. There's financial innovation, how we think about structuring our next rounds of debt so that we're not surprised by that in the future. There's also looking at things from a portfolio perspective. We're operating in 3 markets. Across those 3 markets, while in one market, our currency devalued by a huge amount, across the 3 markets, we're really only looking at about a 12% devaluation, and sort of extracting to a portfolio level and using portfolio management tools to manage risks more carefully. But that said, someone once said about being an entrepreneur is your job is day to day, always, no matter where your business is, crossing off those risks. And I think it goes back to something we've said a couple of times. It's working with practical entrepreneurs and making sure that they are practical, that they're not overly optimistic about the risks, and that they know on a day-to-day how to manage those risks. And so I think that if you work with great entrepreneurs, you work with partners who understand this and can actually help you partner to solve them.
Great, thank you. I'm aware of time, so maybe we'll wrap up there and open up to any questions from the audience.
Hi, I'm William Brent from Husk Power. I'm a colleague of the same industry as Nicole. And I should start by saying that we're grateful to the DFI community. We wouldn't be where we are today without DFC, Proparco, Swedfund, FMO. So that's the opening statement, but there's a but. I'd like to focus on the second A in the, what's the term, ARIA, being accelerator. We found that the average time to close a deal, whether equity or debt, is far more than 1 year or 2 years even. And so I guess the question is there a KPI that you've sort of established a baseline for what the speed of a transaction is that you'll be tracking over time? I would love to understand sort of what the accelerator aspect of ARIA is and how you're addressing that. Thank you.
So maybe just in terms of ARIA, I'll answer the question, then I'll pass on to Dia. Is that okay to answer from the DFI perspective? But ARIA, Africa Resilient Investment Accelerator, it's trying to bridge the gap between DFIs, impact investors, and opportunities on the market. So, we're trying to accelerate the investment readiness of those businesses. We're trying to accelerate the connections between the two. But in terms of DFIs themselves and the speed of transactions, maybe I'll pass on to Dia to to bring the DFC perspective, and then maybe Fadi, the BII perspective.
Sure, I'll just start by keeping it real. On the investment side, a transaction that takes 1 to 2 years to close is just as stressful as well. And that's one of the reasons, specifically for the portfolio for impact and innovation that I mentioned, we actually have a tailored, streamlined process to go through the cycle, because that's exactly what we don't want is a 2-year transaction. With that said, we are a DFI. We have processes and a bureaucracy for anyone that's worked with the DFI. So it is going to take, I would say, a typical transaction with resources allocated. It is going to take a 6 to 9 month cycle to get through approval. If it's a little bit more complicated, it'll take more time. If it's a transaction where you have partners collaborating, they've been through the spill before the routine with the DFI, it could take a little bit less time. So there is the reality of it, taking that period of time as a DFI and the process that we have to go through internally. But I agree with you, there should be some safeguards in place to support these investments so that it doesn't take as long as you've mentioned.
Great, thanks. Fadi?
No, I think most of it has been said already. I've done transactions in 4 or 5 months, but I've also done a transaction that took 2 years because my investment committee kept asking more and more questions that I had to go do work on. But I think asking these questions and airing these discussions I think are important. I think us as DFIs, we all try and say we're getting better and maybe we're not as slow as DFC, but
Oh, really?
But I think you holding us responsible and not being afraid to challenge us and challenge some of our processes and challenge our duty processes to make it more efficient, I think is important. I think we're all aware of it. And for me, I think what's worked really well, and I know I keep banging on about this same point, is when I've had partners, right? So I might be coming to a transaction a bit later than others, and they're able to bring me along, they're able to share some of that DD. That actually can accelerate processes. So that element of sharing and working together as DFIs, I think, is important, and it does speak to this point of trying to reduce the timelines. It sounds like you have a follow-up point, so I'll give you.
In terms of, so I think first of all, measuring the speed of deal flow would be something that we shouldn't be responsible for, that the investment community should, hold themselves to account. So what is the expected time frame to accelerate from is it, 18 months to 9? We don't know. What does accelerator mean, right? But there are also other things within the whole process that I think in terms of group DD would be extremely helpful in terms of, you guys agreeing on what ESG, metrics and there is some of that happening, but there could be a lot more where we don't have to go through individual DD for each DFI or other investor, where there's some pooling of or agreed upon metrics where you guys all come to the table and say, okay, if you guys check the box with DFC, BII will do the same. That kind of thing would be really helpful. But there are other ideas as well, so thanks.
Any other questions?
Thank you. I think it's a very insightful discussion. I'm from Standard Chartered. We do have quite a bit of presence in Africa. The biggest issue that we face is basically how the convertibility, transferability, and the FX risk to manage, because we fund from various locations. Are you all thinking of any new products that can help the banks to work alongside the DFIs mainly in this area? Because that will, I think, elevate the risk appetite to a great deal. Thank you.
Maybe that's one for you as well.
Yeah, sure. I'd love to talk to you. One of the things we started, as part of our move from OPIC to DFC, one of the opportunities we have is to look at local currency financing, and that's something that we're still exploring. but also would love to talk with you. One of the things is we've worked with different banks and markets to develop local currency guarantees, where we're essentially providing a 100% backstop to the bank to lend in local currency. We're also looking at hedging opportunities, kind of any type of cash deposit that we could make. So this is something that we've been doing with individual banks in the markets that we work in, and would love to have a conversation with Standard Chartered, because we can cover essentially a number of markets at once. And also for Husk Power, I didn't get your name, but would love to sit down with you after the panel and maybe talk about some of those suggestions or feedback. I think that's really helpful.
Great, thank you. Any other questions? Okay, great. Well, thank you so much for coming to the panel on investing in frontier markets. Feel free to reach out to us, and especially from the area perspective, if you're interested in investing in Sierra Leone, Liberia, Benin, DRC, or Ethiopia, or have interesting opportunities in those markets, we'd love to hear from you. So thank you so much.
I know the reasons. Can I have your email?